welcome to the Roundup, covering what's important to accountants and advisors across the month of April. Inside this month, the narrowing nexus between self-education expenses and income. But first up, the ATO's Division 7A dilemma. The ATO's warned that it's continuing to find common Div 7A problem areas and have ramped up education to try and eliminate these problem areas. Michael, what are these problems that they're finding?
Yes, this is an area that is definitely in the ATO's sights at the moment, but I think at this stage we are very much in the education space. The ATO is working with professional bodies basically to improve awareness around Division 7A and some of the problem areas that keep cropping up. And look, some of you might have actually joined a webinar that the ATO put on a little while back, which was the start of an education program that will be extending out over some months. One of the interesting things that came out of that webinar was the ATO's comment that even though Division 7A is complex in certain areas, I mean, there are some very, very complex aspects of Division 7A. The ATO's message was that when they look at Division 7A problems and they come across errors, it's not those complex areas that are catching people out, it's the real fundamentals, it's the basics of Division 7A that people just simply aren't getting right. And so some of the things that the ATO has kind of pointed out as being problem areas is simply having loans to shareholders, their associates, where there is just no written complying loan agreement in place. And the accountant, the client, simply isn't picking up on the fact that that could have triggered a significant unfranked deemed dividend to the person who borrowed the money. In some cases, the ATO is seeing loan agreements that are in place, but they don't meet the terms under Division 7A that are required to be a complying loan agreement. For example, the need for that loan agreement to basically be linked to the ATO's benchmark interest rate for Division 7A. What some people do is they kind of try and figure out what a commercial rate of interest might be, and they may well be doing that with the best intentions to try and come up with something that is a commercial agreement, or at least in their minds is a genuine commercial agreement. The problem with that is that if the interest rate used ever falls short of the ATO's benchmark rate across the term of the loan, then you probably don't have a complying Division 7A loan agreement, and again, you could have a pretty significant Division 7A problem. One of the other issues that the ATO is seeing, and certainly we've seen this from time to time, is the problem with people who borrow money from a company, they repay it, but then they take money back from the company again. So there is a pattern of money going in and out of the company bank account to effectively the same shareholders or their associates. The problem with that is that there is a specific integrity rule within Division 7A, which is designed to capture arrangements like that. And effectively what those rules can do is basically prevent the repayment from being treated as a repayment. That is, they say that you need to apply the rules as if that payment or that repayment had never been made. Again, that could lead to a pretty significant Division 7A problem. Now, there are some exceptions to that integrity rule. Common methods of making Division 7A loan repayments, for example, dividend set-off arrangements, they're okay. But there are situations where the application of that rule and that exception can actually be a little bit more complex. If you think about a scenario where you have a private company where the shares are held by, say, a family trust, but where an individual part of the family group borrows the money from the company. Well, that makes things a bit more complex because as an individual who doesn't hold shares in the company, they can't receive a dividend directly from the company, but they can be taxed on an unfranked deemed dividend under Division 7A. What that structure does is it makes it more difficult to arrange for repayments to be made through dividend set-off arrangements. Now, there may well be ways to do that, but it needs to be structured very carefully, and certainly the level of complexity goes up once you have those three parties involved. One of the other things that the ATO points out is in terms of being a simple error that they're coming across is the fact that where a private company holds an asset and it is used by a shareholder or their associate and they don't pay market rates of rent or hire fees, that can be treated as a payment for Division 7A. That was one of the more recent changes to the Division 7A rules, but when I say recent, I mean this is a change that's been around for some years now. The ATO is picking up on the fact, I guess, that a lot of people just don't realise that that's a problem. So there's some really common basic errors that people are making in the Division 7A space, and the ATO has made no secret of the fact that they want to improve the level of compliance with Division 7A. And so there is this period at the moment where the ATO is working through a pretty structured education program, particularly focused on tax agents, practitioners, to try and increase the level of awareness and knowledge when it comes to those Division 7A scenarios.
As we approach lodgement deadlines and year end, are there any key deadlines that we should be conscious of?
Yeah, Division 7A, it's a harsh set of provisions. Basically, if you have taken funds out of a company in certain forms or received a financial benefit from that private company, then you can be taxed on an unfranked deemed dividend for the value of the benefit you've received. And so while the rules are quite harsh, this is an area of the tax system where you can fix problems that have arisen and avoid that harsh tax outcome, but as long as you fix them the right way and as long as you do it by the required deadline. Let me give you a really simple example of that. Let's say we have a client who has a private company and they took some money out of the company during the 2023 income year. And let's assume that those funds are effectively being treated as a loan from the company to the client made in the 23 income year. Now, that could trigger an unfranked deemed dividend for the full value of the loan in the 23 tax return or 23 income year, unless we take certain steps to prevent that from happening. And the two main ways of fixing that up would be to make sure that the loan is fully repaid or it's placed under a complying Division 7A loan agreement. The deadline for doing both of those things is really crucial. The deadline would be the earlier of the actual lodgement date for the company's 23 tax return or the due date for lodging that return. Now, both of those dates for many clients and their companies would actually be coming up pretty shortly. And so we do, in many cases, still have a little bit of time to fix up problems that might have originally arisen in the 23 year. Now, if we don't meet that deadline, effectively we have a deemed dividend, an unfranked deemed dividend for the full balance of the loan that would be recognised in the client's 23 tax return, subject to the company's distributable surplus at the end of the 23 income year. If we go down the path of putting a complying Division 7A loan agreement in place, it's in writing, we've got the benchmark interest rate there, the loan term doesn't exceed the maximum of 7 years or 25 years if we're using a property security arrangement, then that can prevent the full loan balance from being treated as a deemed dividend. However, we will need to make sure that the client makes the minimum annual repayments in order to prevent a deemed dividend from arising in relation to the shortfall in the repayments for that relevant year. The first minimum repayment would normally be due by the end of the income year after the year in which the loan arose. So again, if we use that example of a 23-year loan, the first minimum repayment would be due by 30 June 2024 in most cases. Again, that's a pretty hard and fast deadline. Now, if for some reason there's a mix-up, there's a mistake that occurs, there is the opportunity to approach the Commissioner to exercise discretion and either allow that deemed unfranked dividend to be disregarded or at the very least allow it to be franked. However, don't assume that that discretion will be granted. There's the option for the ATO to do that, but it's certainly not guaranteed. And it's not the sort of thing that I would expect the ATO to grant more than once for one particular client. Now, if the ATO is seeing lots of requests come through from the same accounting firm, that would also possibly raise a bit of a red flag. And so you would want to just be a bit mindful of that as well. So Division 7A, we have sometimes scope to fix problems up after the end of the year in which that problem originally arose, but there are very strict deadlines for doing that. We need to be conscious of that. We need to make sure that we're getting those things done by the relevant deadlines. Now, if you're a Knowledge Shop member, our next quarterly PD session, we are going to be looking at this in a little bit more detail in terms of what the ATO is looking at, some of the things that we should be conscious of, some of the really common areas of mistake. So keep an eye out for that. That's coming up very shortly. We'll be fleshing this out in a little bit more detail. But the key message is the ATO is looking at Division 7A more closely. We're in an education phase at the moment. But what that probably means is that once that phase comes to an end, the ATO will have higher levels of expectation in terms of people getting it right. And if you're getting it wrong, then I suspect the ATO will be far less lenient after this education program has completed.
Now, as you know, when it comes to claiming self-education expenses, there's a lot of grey areas. And in an AAT case this month, the taxpayer was denied a deduction for self-education costs, even though he worked in the general field. Matthew, what can you tell us about this case?
Sure. Look, it's a pretty interesting case or an example of a situation where someone working in the general industry, general sector, general field of study was by itself insufficient to make the self-education deductible. So the taxpayer in this case, Miss Ionita, she came to Australia years ago and she commenced working here in Australia as a dental technician. She was already qualified as a dentist in her original country, Romania, but in order to practice as a registered dentist in Australia, she needed to undertake some assessments and exams. Now, the question was whether those exam costs, including travel and accommodation, these travel and accommodation costs incurred to undertake these exams were deductible to Miss Ionita. And that depended on whether the self-education had a sufficient connection with her current role as a dental technician. The taxpayer first tried to argue that undertaking these exams to become a registered dentist, they helped improve her skills, helped improve her knowledge required of her as a dental technician. And that was basically on the idea that the duties and skills of a dentist and dental technician were quite similar. Well, the AAT looked at that and disagreed. They basically said that a dentist, that job involves advising and treating patients, while a dental technician doesn't do any of that. They predominantly work in a lab to create dentures, to create models and the like, but there's no treatment. And there's no advising of patients and the like. And the two jobs are fundamentally quite different. The taxpayer then produced a letter from her employer saying that her pay had increased quite substantially over the period, well above inflation. And the AAT looked at that and said, look, your pay may well have increased, but that's not necessarily due to the fact that you were undertaking exams to be a registered dentist. The AAT went into the detail of looking at the timing of those pay increases and comparing it with when the taxpayer had completed her assessments and exams. And rather, the AAT said, look, your pay increases may well have been due to the fact that your experience had improved simply over time, simply through doing the job. And ultimately, the AAT concluded that undertaking the exam, undertaking assessments to become a registered dentist didn't really have a sufficient connection with the taxpayer's current role as a dental technician to be deductible.
So what should practitioners be taking away from this decision?
Look, I think the turning point in that AAT decision is that the AAT thought that the job of a registered dentist and the job of a dental technician are probably quite fundamentally different, requiring different skills, performing different duties. And the outcome of that is that a dental technician studying to become a registered dentist, well, that's not sufficiently connected to their current role as a dental technician. Rather, it's designed to open up a different income earning opportunity, a different income earning activity as a registered dentist, right? To put them in a position, a future position to earn income as a registered dentist. And because of that, it's incurred too soon for that self-education cost to be deductible. And that's pretty consistent with what the ATO is saying in its recent released ruling on self-education, TR 2004/3, which basically says that, look, self-education costs, if they're incurred and they're designed to move you up to a higher pay scale within the same role, then that's probably going to be deductible, assuming all the other basic conditions are satisfied. But the ATO distinguishes that from a situation and says that self-education costs probably wouldn't be deductible if they're designed to open up the client to a new position that's quite fundamentally different to their current role. And the ATO does reinforce that by saying that self-education costs, if they're designed to open up a new income earning activity, a new income earning opportunity, then that self-education cost generally won't be deductible. And I guess what I'm trying to say here is that we probably need to be a bit more careful that just assuming that where someone has worked in that general field, general industry of study, that by itself is always enough, especially if that self-education is designed to open up a new role that's quite fundamentally different to what the clients are currently performing. And I guess we need to look at this a bit more closely when it comes to things like situations where clients are studying for an initial qualification to gain entry into a certain profession. And we've seen the AAT, there was an AAT case a while ago that said of a nursing assistant that they couldn't claim self-education costs in studying for a Bachelor of Nursing because that was an initial qualification to become a registered nurse. And the AAT said that, look, the duties of a registered nurse are quite different to that of a nursing assistant.
And that's the roundup for this month. The federal budget, as you know, is delivered on the 14th of May. If you're active on Knowledge Shop's database, we'll send you our advisor-focused analysis of the budget. And for members, of course, we'll send you that white label client version for you to distribute to your client base and make sure they're kept absolutely up to date on the important issues. If you're not a member as yet, we'd love to show you what a difference we can make to accounting and advisory practices across Australia. Give the team a call or jump onto the website and book a time to see what we do. We'll look forward to talking to you soon.